Hi, welcome to the Lifetime Capital Gains Exemption in Canada video series. My name is John McElroy. I will be walking you through the presentation. We are on video number 8 today, crystallizing your Lifetime Capital Gains Exemption. Let's start off by asking, what does crystallization mean? It means locking in the capital gains before the final disposition of the shares. Practically speaking, let's see how it works. Let's say at an earlier date, you want to hold on to your shares. You're not ready to sell them, but you'd like to realize the capital gain. You want to use your lifetime capital gains exemption. And you can do it by increasing the cost base of the shares. Why? So that at a later date, when you actually sell the shares, you can receive cash, and by virtue of the increased ACB in those shares, you're going to receive $800,000 tax-free. Let's see how it works. At the earlier date, you own shares in an OPCO. Let's say the adjusted cost base in those shares is zero. You didn't put any money into the company. This was all sweat equity. You bootstrapped the whole thing. But now you've successfully grown the operating company so that it has a fair market value of $1 million. Now, you're a little worried about waiting because you're asking yourself the question many people ask. What if the government all of a sudden decides to cancel the Lifetime Capital Gain Exemption program or benefit? You want to lock in your capital gain without selling your shares. Well, voila, that's what crystallization does. It locks in the capital gain without selling your shares. Now let's look at the difference between selling your shares when you're using your lifetime capital gains exemption versus not using it, just so we can remind ourselves why it's worthwhile. If your proceeds of disposition are $1 million because you sell it at fair market value, and your cost base was zero, your capital gain is $1 million. So you could potentially owe tax of between $185,000 and $250,000, pardon me, depending upon the province where you live. If you sell your shares using the lifetime capital gains exemption, the fair market value is still $1 million, but your adjusted cost base is no longer zero. It's now $800,000 because of your crystallization. Now your taxable gain is only $200,000, and the tax owed between $39,000 and $50,000. So selling shares without the lifetime capital gains exemption versus selling it with it, tax owed up to $250,000 without using your exemption, maxes out at $50,000 if you do use it. The tax savings are substantial. And what crystallization does is lock in those tax savings. So how do we go about it? Well, at the earlier date, you have to undertake a corporate reorganization. There's a number of ways that it could be done. Here's one possibility. In essence, what you do is you take your common shares of your operating company and you sell the shares to yourself. That's not technically what you're doing, but conceptually, it's not a bad fit. Let's say you exchange your common shares for Class A shares, and you do it on a tax-deferred basis using a rollover. Under tax rules, the taxpayer can set the amount used for proceeds of disposition. It can be anywhere between zero and fair market value. So you've got a choice in terms of what you're going to deem your proceeds of disposition when you basically sell your common shares and you take back Class A shares in return. Let's say the taxpayer chooses $800,000 for the proceeds of disposition. All right. If $800,000 of the proceeds of disposition, you decided that, your adjusted cost base is zero. So when you trade those shares in, you basically disposed of them and you got $800,000 in return. And since you had no cost basis in them, you have a capital gain of $800,000. But that's exactly offset by your capital gains exemption of $800,000. Therefore, you have a taxable gain of zero. All right, so you did this exchange. You traded in your common shares for Class A. You didn't attract any tax. What's the benefit? Well, after reorganization, you now own Class A shares in the OPCO. Those Class A shares have a fair market value of $1 million, but now they have a cost basis, an ACB of $800,000. So when you decide to sell the Class A shares for fair market value, let's say a little ways down the road it's time to sell and the fair market value of your company hasn't changed, it's still $1 million. So your proceeds of disposition is still going to be a $1 million selling your Class A shares. But the adjusted cost base of the Class A shares isn't zero, it's $800,000 by virtue of the fact that you did your corporate reorganization at the earlier date. That's your ACB. Now you have a taxable capital gain of $200,000, which means the only tax you're going to owe is between $39,000 and $50,000. So that's how crystallization works. But the question remains, and tax practitioners are very vocal about this, just because we can crystallize our capital gains, should we crystallize our capital gains? Like most things, there's advantages and disadvantages. Let's take a look at them. Advantage number one, I've already alluded to, and that is you can maintain your exemption even if the government cancels the Lifetime Capital Gains Exemption. You don't care because you already have that $800,000 basis in your Class A shares. Advantage number two, this one could be big. You no longer have to worry about the accumulation of bad assets. The longer it takes somebody to sell a successful company, the greater the headache that bad assets become. If they do an early crystallization, once the crystallization is finished, they no longer have any concern about the buildup of bad assets. Advantage number three, it can be made part of an estate freeze to reduce the overall costs, right, which can be handy because whenever we're doing a reorganization, there are definitely professional fees involved. But there are some disadvantages with crystallization as well. Let me cover a few of them. Disadvantage number one, you might crystallize on the wrong shares or the wrong investment. What does that mean? It means it's always possible that something could go wrong between the earlier date and the later date. The earlier date is when we crystallize the gain, and the later date is when we want to sell the shares. And if something goes wrong in between those, for example, the shares lose their value or the shares can't be sold, what happens? Well, we have all the disadvantages of the exemption, but enjoy none of the advantages. Because we can only do this once, right, we want to make sure that we crystallize on the right shares. Disadvantage number two, it does reduce the allowable business investment loss available to the taxpayer for use in the future. Now, ABLE is a pretty decent little program where we can take capital losses in special situations and use them against income. And that using capital losses against income is typically not something that we can do, but under ABLE we can. So it's not an insignificant disadvantage to be in that situation. Disadvantage number three, it does reduce the special capital losses provisions that are used at the time of death. Definitely worth noting. Disadvantage number four, could be subject to the alternative minimum tax provisions, the AMT. Tempted to go into a history on AMT, but I won't. So this even multiplies the problems because you could have AMT, meaning you have to pay at least some tax when you reorganize and crystallize. So now you're out of pocket tax expenses, but you don't ever actually get a chance to realize your gain. Disadvantage number five, if not structured properly, subject to the deemed dividend rules, it can negate the benefit. Do the advantages outweigh the disadvantages? Well, it differs case by case, which is why I will reiterate something I have mentioned many times. Professional tax advice is needed if you want to crystallize your capital gains exemption. Don't try this at home. Find a tax practitioner and get some help. It's so easy for things to go wrong when you're contemplating a transaction like that. I hope you enjoyed the video. My name is John McElroy. My number is 905-267-1043. Give me a call. Always love to hear feedback. My email is in the comments below. I would love to hear from you. Meanwhile, I will see you in the next video.